Have you ever wondered how Warren Buffett makes his investment decisions? Ever heard of value investing? Value investing is a fundamental strategy that involves purchasing stocks at less than their intrinsic or true value. It's like finding hidden gems at a thrift store. You're looking for quality items that are undervalued and have the potential to increase in worth over time. The concept of value investing was brought to the limelight by two great minds in the world of finance, Warren Buffett and Benjamin Graham. Buffett, one of the most successful investors of our time, was actually a student of Graham, who is often referred to as the father of value investing. These two figures have proven the effectiveness of value investing through their impressive track records. Understanding value investing involves learning key criteria for filtering value stocks. It's like having a checklist that helps you sift through the vast market to find those undervalued gems. Ready to dive in? First up is the price-earnings, or PE ratio. This is a valuation ratio that compares a company's current share price to its per-share earnings. Think of it as a price tag for a piece of the company's earnings. The legendary investor Benjamin Graham often advised looking for stocks with a PE ratio below 15. Why? Because a lower PE ratio could suggest that the stock is undervalued. So, a low PE ratio can indicate a potentially undervalued stock, but remember, it's just one piece of the puzzle. Next, consider the price-to-free cash flow, or FCF ratio. This is a measure of a company's financial flexibility and health. Essentially, it's the cash a company has left over after accounting for capital expenditures. It's a favorite of Warren Buffett, who prefers companies with positive and stable FCF. Why? Because it leaves room for growth, dividends, and debt reduction. So, when you see a lower price FCF ratio, it could mean a company is undervalued, offering a potential opportunity for value investors. Two more key criteria are the price-earnings growth rate, or PEG, and the price-to-book, or PB ratio. The PEG ratio is a valuation metric that considers a company's projected earnings growth rate. It's a refinement of the PE ratio that factors in the growth rate of a company's earnings. According to Benjamin Graham, a PEG of less than 1 often indicates an undervalued stock. Now, the PB ratio is a comparison of a company's market value, or price, to its book value, which is the value of the company according to its financial statement. Graham favored companies with a PB ratio of less than 1.5, suggesting they may be undervalued. But remember, these ratios help identify potentially undervalued stocks. They are not infallible. Always analyze in conjunction with other criteria. Each company is unique, and these numbers are just part of the larger financial story. Now, let's talk about financial health metrics, the debt-to-asset or debt-to-equity ratios, and the current or quick ratios. The debt-to-asset and debt-to-equity ratios provide insight into a company's financial leverage. A lower ratio indicates that a company is using less debt to finance its assets or equity, which can be a good sign of financial stability. On the other hand, the current and quick ratios measure a company's ability to cover its short-term liabilities. A higher ratio here indicates that the company has more than enough resources to pay off its short-term obligations, suggesting good liquidity. The legendary investor Benjamin Graham advised looking for companies with lower debt ratios and higher current or quick ratios. This combination often signifies a financially solid and low-risk company, which could be an attractive prospect for value investors. A financially healthy company is often a safer bet for value investors, but remember to consider all criteria before making a decision. Last but not least, payout ratio and management ownership percentage. The payout ratio is simply the proportion of earnings that a company pays out as dividends. It's a clear indicator of a company's profitability. On the other hand, management ownership percentage shows how much of the company's stock is owned by its own management. It's a confidence signal. If the management believes in the company, shouldn't you? Warren Buffett, for instance, prefers companies with high management ownership and a reasonable payout ratio. These last two criteria can provide additional insights into a company's investment potential. So, you've got your criteria for value investing. What's next? Let's recap. Value investing is about finding stocks that are undervalued using criteria like price-earnings ratio, free cash flow, PEG and PB ratios, debt ratios, and management ownership percentage. But remember, these are just tools. The real art is in using them together, doing your due diligence before making a decision. Remember, even Warren Buffett doesn't rely on just one criterion. It takes a keen eye and a holistic approach to spot true value. Happy investing.